You may already be familiar with trading stocks or shares. At its most basic level, as an investor, you ideally want to buy stocks when the price is low and then sell them when they are high, returning you a profit. However, there is a huge world out there that allows for much more flexible strategies. Enter the world of options trading. Hi everyone, my name is Kieran King and today I'm going to give you an introduction into this world. So without further ado, let's get cracking. What exactly is an option? An option is a contract between two parties, a buyer and a seller, that gives the holder of the option the right, but not the obligation, to buy or sell a certain number of shares at a certain price within a period of time. Now, I know that might seem like a mouthful right now, but we're going to break it down. So this right to buy or sell a certain number of shares, okay, they're classified into two types. The right to buy is called a call option, and the right to sell is called a put option. You've got calls and you've got puts. And this is what people buy and sell in the trading market, okay? And this means that you can do four things essentially with options. You can buy calls, you can sell calls, you can buy puts, and you can sell puts. So buying a call is buying the right to buy certain shares at a certain price within a period of time. Selling a call is selling the right to buy certain shares at a certain price within a period of time. Buying a put is buying the right to sell certain shares at a certain price within a period of time. And selling a put is selling the right to sell certain shares at a certain price within a period of time. Now, this may sound complicated, but we're going to go through an example, and hopefully it won't be complicated after this example. So let's draw two people. We have Peter and Mary. For the purpose of this transaction and this example, we're going to use Tesla stock. Okay, so, and its ticket symbol is TSLA in the top right there. And let's say that Tesla currently has a market value of $900 a share, meaning you can currently buy and sell Tesla shares at that price. Now Peter, he thinks that shares in Tesla are going to go up in the next few weeks, and he thinks they're going to go up to something like $1,100 a share. Now he could buy 100 shares of Tesla, setting him back $90,000, wait for them to go up and then sell them for a profit. Yeah, he could do that. Or he can buy an option from someone else who doesn't think Tesla shares are going to go up and who is selling him that option. Okay, so Mary, for instance, doesn't think that shares are going to go up. Mary thinks they're either going to stay the same or they're going to go down. Okay, so Mary then says to Peter, she says, I will sell you a call option to buy 100 shares of Tesla at $1,000 a share, expiring in 1 month's time. This means that Peter has the right, okay, within this period of time, which is 1 month, okay, to buy 100 shares of Tesla at $1,000 a share off of Mary. So the market value is 900. He's got the right to buy within 1 month of this option 100 shares at $1,000. But Mary, of course, wants something for this option in advance, okay, and so Peter has to pay, let's say, a premium price of about $2,000 just for this option. But you may be asking now, why on earth would Peter want to buy shares at $1,000 if the current price is $900? Because he could just go to the market and buy shares for $900. Why would he want to buy shares at $1,000? Well, it doesn't make sense to for him, at least not yet. However, let's say a few weeks later, Tesla shares do go up to what Peter thought, $1,100 a share. Now Peter has the right to buy 100 shares of Tesla at $1,000 as opposed to $1,100. So let's say Peter exercises this right. That means that he can spend now $100,000 to buy 100 shares in Tesla, and he pays Mary $100,000. Those shares need to come from somewhere, and Mary, having sold this call option to Peter, needs to now provide those shares of Tesla. So what is Peter's profit in this way? Well, Peter's $100,000 that he spent is now technically worth $110,000, because remember, it's at $1,100 a share now. So a growth of $10,000. Now if we subtract the original $2,000 premium that he paid for this option, he has a net profit of around $8,000. And what about Mary? Well, Mary sold the option for $2,000. She collected $100,000 from Peter, but now has to provide $110,000 worth of shares in Tesla. So in essence, she now has lost $8,000. I hope this makes sense. Let's look at another scenario. Let's say Tesla's shares increase beyond expectation and reach $1,500 a share in a couple of weeks. Peter decides to exercise this option and now has the right to buy 100 shares at $1,000 a share, which he does, and Mary now needs to provide those shares. So Peter has essentially gotten $150,000 worth of Tesla shares for $100,000. And Mary has essentially sold $150,000 worth of Tesla shares for $100,000. And if Peter decides to sell those shares, his profits is therefore $50,000 minus the amount he paid, which was the $2,000 premium, netting him a profit of $48,000. Now, as you can probably see, the amount Peter can make by buying this call option is pretty much unlimited. Now, it's important to note you can't just keep using these options, okay, unless you buy them again. As soon as you use it, that's it. It can't be used again. So what benefit does doing it this way have to Peter? Well, Peter, he didn't have to fork out $90,000 to start with. All he had to pay was $2,000 to Mary in order to get this option. And now for one more scenario. This time, instead of increasing value, let's say Tesla shares actually lost value and then reached $800 a share by the end of the month. As Peter has the right to buy 100 shares at $1,000 a share, it makes no sense for him to exercise this right, as he can actually buy the shares for much lower in the market at $800 if he wanted to. Mary, on the other hand, who has waited for the option she has sold to expire, has pocketed a nice profit of $2,000, okay, the premium money she sold the option to Peter for. So that's a basic overview of how options work and their value. But what happens in the real world is that these options aren't actually exercised a lot of the time, okay, and this transaction doesn't actually go all the way. Instead, these option contracts are literally just traded around with each other, and the exercisable full value is actually built into the price that people buy and sell these options for. But I'm going to save that for another video. This is just to serve as an introduction into options. So that in a nutshell is how options work using a call option transaction as an example. If you like this video and want to learn more about options, then please subscribe and please let me know in the comments. Take care everyone, and I'll see you all soon.